Hi, Ken. Thanks for meeting with us again today. A lot of people are moving towards online investing tools and online investing. What are your thoughts about that?
I think it's great. As a matter of fact, online investing tools has really made my business. Without online investing tools, I wouldn't be able to use TD Ameritrade or Scottrade. And there's a number of tools that are available. In today's world, what I use, there's a whole industry that have money letters or that follow the market. And a lot of these are based on online investing because people can do it themselves. But it's really interpreting what those letters mean. For instance, I've used Bob Brinker and I've also used No Load Fund X.
Are those online investing tools?
No, they're really not. They're money market letters, and you use those letters. And then you go to your online investing, kind of check it out. But it's really being able to interpret what they're saying. For instance, Bob Brinker is great at giving ideas, but he offers very little particular advice. But it kind of gives you a big general background of the market, where No Load Fund X kind of gives you a number of different investments, but doesn't really give you the follow on how to diversify your portfolio. And I want to talk a little bit about, Ron, where the market is going today. And I have here a chart. We're going back to 1998, and this is really a chart of the Standard & Poor 500 from 1998 till 2014. And you'll see here, this was the, in 2000, this was the technology bubble, the internet boom. You see how it went straight up. And then when we had the boom fall into about 2001, it fell down here to almost a low of about 8,500. It went from about almost cut in half. And then at this point here, we had George Bush and the housing boom that followed. And you can see it went almost up to the same exact amount. We call this the support resistance line. And it fell down here again when we had the banking crisis and mortgage crisis. And it fell down here to the bottom. You see it almost to the same part right in here. So what I'm saying is that markets have memories. And they call this charting or technical support. And so it went up here, and here we're down here about 2009. I like to say I got here in the bottom. I really didn't. I got in about June, which was in about here. And what I did that because I seen this this oscillator line start to head up, and I knew it would probably go higher. And so it went higher. And an interesting thing happened here. There was a little bit of hesitancy here when it went through this resistance line, but once it went through on a commanding lead with very strong volume in here. And that was an indicator that was even going to go higher. Right now, the support level was about 1,500, and now it went higher up to about 2,000. I don't think that we're going to go down below this line. I think it provides a very strong level of support in here. And I think that you'd be well advised in there that you can advise we're going to have market's going to move ahead and back full and back full. And I think the market will go higher from here on in. I don't think it's going to go below this support level that was been established for the last 15 years. And the pattern is very distinct. It's easy to see it, and there it was right in here.
That blue oscillator line you were talking about right there, down below?
Yeah.
How did you know that market was going to shift when you saw that rising?
I've seen it kind of shift. There's two
What does
lines.
that blue line represent?
This line represents what's called the MACD, and it's very technical, and I'd be happy to explain it in detail. But when there's a gray line and a blue line, and when that gray line crossed back in here, it was heading up, and then this oscillator here was heading up. I knew it was probably going to go up higher from the bottom. And not only that, the fundamentals, the earnings of these companies, the book values, and the dividend yields were there to give very strong support. And I knew it was probably head up. Now, as I say, it's easy to see this in retrospect. The market bottomed in March. I didn't get back until June. And it was a very trying time in that 2009 era. As a matter of fact, one day I can remember I spent the whole day, I had a lot of the money in cash, and I was just wondering, even the money market funds were starting to freeze up. And I spent one day in a panic trying to determine I had the right money market fund, which I did. And that was a relief. So that just shows you the amount of panic at that time. and it's not hard to look back. So anyway, we've had a great market run. What the takeaway I'd like to you take from this is that we've got strong support in here. We can maybe fall 20%, but we're not going back into these crises. This is once in a generation buying opportunities. And another thing I'd like to point out, this time the price earnings ratio in here in 2000 was about 33. Now after 10 years of sales and earnings growth, we're down here to about 15 or 16 times. So there's really meat and potatoes behind some of these stocks.
Thank you, Ken.